If somebody tells you that they can predict what the stock market is going to do in the future, run away. Never believe them. But is there nothing that you can do to make an estimate of which are the good companies that you should invest in? With thousands of companies to choose from, let me show you what do I do before I make an investment in the stocks. We are doing a giveaway with this video. These are 3 great books to choose from which will help you in your financial journey. So, what do you need to do to win this book? Well, 3 simple steps. Subscribe to this channel, click the bell icon and watch the video. Simple? Throughout this video, alphabets will appear at random time which will make a Google form link where the form is hosted. Use the link forms.gle/ and the alphabets to go to the form, fill in your details, and if you are among one of the winners, I'll send you the book that you choose. And do let me know that you have filled the form in the comments below. There are 2 ways in which you can study the stock of a company: fundamental analysis and the technical analysis. Short-term traders only focus on the technical aspects. They focus on what the chart is telling them. But for long-term investors like us, we need to focus on the fundamentals of the company and occasionally see the charts to figure out what is the best time to buy these stocks. But before we jump in to do the fundamental analysis, we need to identify that which company's analysis we should do, right? Okay, there are 5 basic factors that you need to consider before you start the detailed analysis of a company. And do not think of this as a maths or a number thing. This is a very logical, common sense based criteria. This may sound complicated, but it is not. Number 1, revenue growth. Suppose you are going to buy a grocery store in your locality. Now, what is the purpose of your investment? That the value of your investment should grow, right? But if the sales, the revenue of that shop is not increasing year on year, then how will your investment value increase? Let's see TCS as an example. We'll go to the profit and loss account and see the sales numbers. In the last 5 years, it has grown from 117,000 crores to 191,000 crores, and it has been growing, so that's a good sign. Number 2, profit growth. Revenue growth is not the only important factor. The profit must be growing too. There is a chance that companies' costs may also be increasing with the revenue, which is not so good for the investors. In any business, how do costs compare to revenue? Let's say FMCG sector, Britannia. Now, even before producing one biscuit, Britannia will need to invest in the factories and set up the whole factory and the machines. Now let's see this with a graph. We have amounts on this side and the units of biscuit that Britannia produced on this side. Now we'll have a fixed cost to set up the factory. This is a straight line and it will remain same even if the production is 0 units or 1 lakh units, right? Now we'll have some monthly variable expenses like milk, sugar, flour to actually produce the biscuit. This will increase according to the number of units produced. If the factory is producing only 100 units, the cost will be lower. If the factory is producing 1 lakh units a month, the cost will be higher. And the total cost will be a sum of this monthly variable cost plus the fixed cost. Now, when the production starts and the company starts to sell the biscuits, this is how the revenue line will move. As long as it is below the total cost, the company is running in losses. At some point, it will be a break-even situation, no profit, no loss. And when the revenue line goes above the total cost line, the company is in profit. This is how it generally works. But if the profits are not increasing, then that's not a good sign for the company. Let's see for TCS. The revenue growth is translating into profit growth as well. 26,000, 25,000, a minor dip here, and then it keeps on increasing for the next 4 years. Number 3, free cash flow growth. Why is cash important? See, the large contracts of crores of rupees that the companies take up, the amount is usually not paid upfront. The amount is usually paid on the basis of the percentage of completion of work done. Now, for example, if the first payment will come in after 6 months when the 50% of work is done, the company still needs to pay salaries for these 6 months. And when the costs are in crores of rupees, how long do you think the company will survive if the cash is not coming in regularly, but the payments have to be done on time? So that's why it's necessary to see how much cash is coming in the business. Okay, assume that a company has made 1 lakh profit every year for the last 10 years, but the free cash flow has been dropping for the last 3 years. Customers have been delaying the payment and the suppliers, the vendors, have been asking for quicker payments. Now, this shows a very dire financial situation. Now, in this case, free cash flow would show a serious financial weakness that wouldn't have been apparent just from checking the profit and loss account. Now, how much cash flow should the company have at least? Enough that the 5 years of total cash flow should cover its long-term liabilities. Let's see Adani Total Gas. Go to the balance sheet. Long-term liabilities, we have 461 crores. Okay, let's go to the cash flow now and check out the free cash flow. The total of 5 years cash flow is 482 crores, which covers its total long-term liabilities of 461 crores. But you see another problem here? The cash flow has been decreasing year on year. If the cash flow would have been increasing, we would have assumed that the company would be able to pay its total debts, and that would be a good sign. But with a decreasing cash flow, it's not good. Let's see Pidilite, 546 crores of long-term debt and 138 crores of free cash flow. The company can take care of 2 times of its long-term debt with only 1 year of free cash flow. Companies with strong cash flow are the ones which can survive in the downturn. Do you want to see TCS? Long-term debt of 8,700 crores and the free cash flow of 37,000 crores. Beautiful. Number 4, return on equity. ROE is a measure of the efficiency with which the company generates the profit. Return on equity is equal to net income divided by average shareholders' equity. Generally speaking, an ROE of 15 to 25% is a good number, but it will also depend on the sector in which the company operates. We are on screener.in and we are going to see sector-wise analysis. Let's go to cement sector. We'll click on ROE and sort it highest to lowest. If ROE is not there, you can click on edit column and select the criteria that you need. Now the highest ROE we have here is 52%, and then it goes down to 20%, 19%, 17, 16, 13, and then in single digits, then 0 and then negative. Let's see the companies that we know. JK Lakshmi Cement 21%, Digvijay Cement 17.77, Ultratech 15.5, ACC 14.09. So you see, except one outlier, in this case 15 to 25% is a good range. Let's see IT software. We'll click to sort highest to lowest. It starts even higher. TCS 43%, Tata Elxsi 37%, Happiest Minds 31%. So you see, for this sector, your ideal ROE will be higher. A good rule of thumb is to target ROE that is just above the average ROE for the sector in which the company operates. Now, I said average ROE of the sector. Average or slightly above average ROE is better than double or triple the ROE of the sector. Now, isn't that confusing? Why isn't a very high ROE better? There is only one major reason when high ROE is good. The company's performance is actually good, actually strong compared to the equity base of the company. But a high ROE can be due to some other not so good reasons also. For example, a company may take debt to buy back the shares, which will increase the earnings per share without improving the performance of the company. Right now, we are not going into the details of why is it not good to have extremely high ROE. Look at the performance of the sector and you can start your analysis from there. Number 5, PE ratio. Price to earning ratio measures the current market price relative to its earnings per share. PE ratio is equal to market price per share divided by earnings per share. For TCS right now, the market price is 3,275 and the earnings per share is 105 rupees. Dividing 3275 by 105, we have a PE ratio of 31.18, 31.2 here. But what does PE means? It simply means what price you are willing to pay today to get 1 rupee earning from the company. From TCS, the investors are willing to pay 31.2 rupees to get 1 rupee from the company. Now, it also means that the current market value of the company is 31.2 times of its annual earnings. If you were to hypothetically buy 100% of TCS, it would take you 31.2 years to recoup your initial investment on the basis of the ongoing profits of the company. Sometimes you would have heard that the PE ratio of a company is too high. It should be between 15 to 20. What does that mean? Like ROE, PE ratios should also be measured sector-wise. So you cannot compare against one standard number. PE ratio holds most value when compared against the companies in the same sector or when compared for a same company across a period of time. So do not start comparing PE of TCS and HUL. It needs to be seen in relation to an industry. Let's see PE ratio of Nifty 50 companies. Sort by highest to lowest. HDFC Life Insurance 121, Titan 79, HUL 59, TCS 31, and it goes all the way down to single digit. So what is the average PE of Nifty 50 stocks right now? Well, right now it's 19.5. Let's see sector-wise PE. Let's go to FMCG. We'll click on PE and sort by highest to lowest. Nestle's PE ratio is 74 and Dabur is 50. Does this mean Nestle is overvalued? Let's see their ROE. Dabur has given a return of 22%, while Nestle has given a return of 113%. In this case, it looks like investors are willing to pay a higher price for Nestle, and that's why the PE is higher. But that's not all. To identify whether a company is overvalued or not, you need to see the valuation of a company. We'll see the valuation in the next videos. Some of you may have seen that in the stock market recently, one business group's stocks have been going up, driving its PE into several hundreds, even though the group companies carry extremely heavy debt. If you know what I'm talking about, do let me know in the comment section. So, start with the sector that you know about and shortlist the companies using these 5 steps. And then you can deep dive into the fundamental analysis of the company and figure out whether you should buy a stock or not. Now, when you have done your research on the stock and the sector, you will know why you are buying a specific stock. If the price still goes down, you will know whether it is going down because of the company's specific reason or just because the whole market is down. But if all this seems complicated, you can consider buying the index funds. Index funds are truly a great option for the investors even if you don't know much about stock picking. Thank you for watching till the end. I hope you liked this video. I'm going to leave 2 more videos for you here. Do check them out after you hit the like button. Hit subscribe if you want to grow your wealth and press the bell icon. Wrapping it up, this Paritosh signing off.